Overall, I expect the gold and silver will have a very adventurous year. It looks like people are positioning for different directions in gold and silver for the year. We'll pay attention to that because it matters, because that's what drives price. But the big news here in terms of the bullion trade is the bullion banks have gone net short silver. Hey everyone, this is Rob from goldsilverpros.com. It is January 6, 2023. I'm recording this about noon Central Standard Time, so all prices and quotes on investments will reflect that time period. We'll put this out probably Sunday evening or Monday morning, which you'll get before the markets open, so you can use to plan out your week and know what is going on. As of the time of this recording, gold is doing pretty well. It's up at 1861.88. It has punched through a key resistance level at 1846, which I just talked about on the show yesterday, which is nice to see gold going up. It's up about $30 on the day, excuse me. Silver is at $23.79, up 57 cents on the day. Looking at what we saw this week with the major economic reports and data points, we saw the S&P Manufacturing Index come in exactly as expected at a print of 40.2. Construction spending was a little bit below expectations of 48.4. They had it 48.5, so it's about where they thought it would be. Job openings at 10.5 million, quits at 4.2 million. And the FOMC minutes that were released Tuesday at 2 p.m. Eastern time, all basically the Fed basically said they're not going to they're going to continue to raise interest rates. The target right now is about 5.25%. They're not going to continue to ease this year. They don't see the need for it. We'll see if they continue that stance throughout the year. Motor vehicle sales are way down, 13.3 million versus 14.2 last month. Then, of course, the big news is always the jobs report. ADP came in at 235,000, which was a lot higher than expectations of 153, while initial jobless claims came in lower than expected, 204,000 versus 223,000. Continuing jobless claims for those that continue to be jobless up until about a year time frame where they fall off the official numbers is 1.69 million, a little bit less than last month at 1.72. The trade deficit is moderating as we have deflation. We're down now only 61.5 billion a month, meaning we buy 61.5 billion more in merchandise from the rest of the world in the last month than they bought from us. And that's imports over exports. But that has fallen. Last month it was 77.8, and I believe that's because we're in the deflationary part of this multi-stage inflation cycle. S&P U.S. Services PMI, looking at the services market, is at 44.7. It's about what expectations were, slightly higher, although it's negative in terms of it's not accelerating. It is decelerating just a tad. Non-farm payrolls, the big pay report from the government, came in at 223,000 new jobs, above expectations of 200, but below last month at 256,000. As a result, the unemployment rate came in at 3.5, a little bit lower than the 3.7 expected. Hourly earnings did raise just a little bit at 0.3% for the month, which is about 3.5% for the year. It does not keep up with CPI, and we'll get those CPI numbers next week. It looks like, to me, average hourly earnings are a little bit less than official inflation. So that means that about 3 to 4 to 5% clip conservatively, wage earners are losing purchasing power per year. Of course, that's looking at the government numbers. If you look at shadow stats and what we think are real inflation numbers, it's much higher, probably around 17 to 20%, or it was, although it's probably coming down just a little bit. Factory orders were a negative 1.8%, meaning that we're not ordering as much stuff, and I believe that's because we're in the deflationary cycle. And the ISM Services Index, another measure of the service economy, was down below 50 at a 49.6 print. That's a slight deceleration. Way under expectations, however. Economists expected the service economy to do a 55.1%. Didn't turn out that way. Looking at the markets, the Dow Jones is trading up 517 points. The headline on CNBC is that stocks stage first big rally of 2023 as hopes of easing inflation grow. Dow up 500. I don't know where they get that, because the Fed was not particularly was not particularly frothy on the economy. I think that's the market just making it up and having a little beginning of year enthusiasm. I don't think that will probably last, but we'll see what happens. So Dow is up 1.57%. The S&P is up 1.57%. The NASDAQ is up 1.61%. And the Russell 2K is up 1.91%. If we look at the bond markets, we're still in yield curve inversion, indicating an oncoming recession. That's why I don't understand the stock markets. The U.S. 1 month is at 4.198, and every Treasury issuance from the 1 month all the way up to the 10-year is in backwardation with the 10-year. In yield curve inversion. The 10-year is at 3.589. Every other issuance from 7-year to 1 month is at a higher rate. That means that bond investors see more short-term risk in the economy than long, which is an indicator of an oncoming recession. If we look at the cryptocurrencies, we have a little bit of red today. Bitcoin is down $44 to 16,807.22. We have Ethereum up $9.61 to 12.62. 62. Litecoin is up 66 cents to 75.35, and that's all the ones that I care to quote to you. Wage growth is down. So there's a chart here from the Labor Department. I'm going to share a screen and show this to you guys. And this situation really kind of depicts what's going on with hourly earnings. As noted, we are on a decidedly downward trend in 22 with respect to wage earnings. So the average that weekly wage earners are earning, the acceleration in that is declining. So in other words, they're still getting more in terms of their wages, but the amount that they're getting more is decelerating. So the rate of acceleration in wage growth is slowing down, and pretty soon we may go to a negative print. We'll have to see. Here's some charts that somebody wrote an article on Zero Hedge and put out there with regard to the BLS report on non-farm payrolls. And what they do is they compare a couple of things. They're looking at average weekly hours on employees. Not only are wages going down, wage increases, but the overall hours that employees can work has gone down since the pandemic. There's also a difference between the household and establishment survey. The establishment survey is a survey that doesn't look at actual households. It looks at proxies for this in the economy, but the actual household survey done actually queries households and is more real data. And the household survey has been for quite some time showing more unemployment than the establishment survey. The household survey was closer to the other unemployment report that we got before the ADP, before they changed it. The ADP now changes to be more like the establishment survey. So now you're getting a lot of playing around with the numbers, and you can't compare past periods for ADP and all that stuff. But it appears as though when you get real boots on the ground data, unemployment's actually worse than what you get through these proxies, and that's shown by these two lines. And this is the difference, about 2.1 million, which is a lot of jobs. Job changes November to December. We increase part-time and a lot of multiple job holders. That means full-time, we did not have an increase. I think it was like -1, so about the same, but part-time jobs went way up and multiple job holders. So when you see a certain amount of jobs in the economy, a certain amount of people, you have to account for the fact a lot of people have multiple jobs. So it may actually be less people employed than the BLS actually believes. And I think that is borne out in the labor force participation survey, which you can see, which is just simply the amount of money, the amount of people in society that can and are willing to work versus employed, and that's down to 62%. So that would be basically a 38% unemployment rate if you consider all those people. And when you add in the fact that we have multiple job holders and part-time jobs, the unemployment situation is not quite as rosy. March to December of a longer time frame, full-time jobs went way down in the economy, part-time went way up, and multiple job holders went way up. Now we're going to switch over to going over gold and silver. We're at the CME's website. We're going to take a look at gold first. We're going to look at volume and open interest. Not a lot going on in the January contract. We're just going to get this year's data, guys. We're in 2023, and this is just the way that they choose to do this. Of course, we can go back if we want into previous months or go forward. It looks like it doesn't look like we're going to go back and get the old data. So it looks like we have 1 day's worth of data here for January. We sell at a price of 18.55. Not much trade going on. Volume of open interest on the February contract. 358,000 contracts, pretty good. EFP 6214. So in February, there were 6,200 contracts of gold that they went and got the gold, or they went and did price arbitrage with the London market. I suspect that there may not be as much liquid gold on the COMEX because we've seen these EFPs. And what this is exchange for physical between a futures contract in COMEX and the potential for basically for an OTC contract in London, and the potential to actually get that metal, or maybe play price arbitrage between the two products, the two markets. But this indicates that there may not be enough available gold in COMEX to satisfy current demand. That's something that we'll continue to pay attention to. If we look at the settlement data, which tells us where the price went, as of yesterday's data, Thursday, January 5th, we had 190,000 contracts closed on the dominant month of February for gold, and they settled down at about $18.40 to $18.40.60. If we look back 1 day at Wednesday's data, again, the February is the dominant contract. Estimated volume for the day, 200,000. Average close, $18.59, up $12. So we've seen a little bit of back and forth on gold. Definitely overall starting the year very well. Looking at the actual depositories, COMEX has lost a fair amount of gold in the last 4 weeks. This is a rolling 4-week chart we look at every week from Nick Laird's site, Gold Charts RS. So overall, a reduction in the amount of ounces of gold in the COMEX. And if you look here, the last time we covered this, there were 13 million ounces of gold in registered, which is the liquid tradable inventory in COMEX, whereas eligible is private storage and therefore not liquid, unless people want to put it in registered. There's a process to do that. This is down 2 million ounces in just a couple of weeks. So gold is being taken off the COMEX. It looks like the last 4 weeks, about 500,000 out of registered, 300,000 overall off the depository. Some has come into eligible. And if you look at the biggest London holding, which is the GLD, they're showing a decrease in the metals dating back to silver squeeze. We've covered that a million times. Let's look at the next big one, the iShares IAU ETF for gold. And that one also has seen a runoff. So a lot of physical is coming off. And therefore, overall, you do, however, have a little bit between London and the COMEX markets, a little bit actually coming on the last 4 weeks, although the trend the last couple has been to come off. Going on to silver, we're going to look at volume and open interest. Open interest is pretty much lower than average, starting the year a little bit lightly. Looking at Thursday's data, the dominant contract is March 2023. We had 114,000 contracts at close. We had 600 contracts exchanged between the COMEX to London, presumably to get the 5,000 ounce each contract of silver. If we go back a day and look at Wednesday's data, same thing, 117,000 contracts closed for silver, 408 EFPs over to the London market. Look at where we're settling on these actual deals. We see they're closing. Where's the price going? This is Thursday's settlement data on the COMEX for the March dominant contract. 60,000 closed yesterday at an average price of $23.42, which is silver closed down 54 cents on the day. This is how it's determined. You take all these contracts, you average out the price that they settled at. That gives you the settlement price for the day, and that gives you the spot price. That's how that works. That's why we cover this data every single week. It's telling you how we get to the spot price. Well, on Wednesday's data of this week, the trade for the March contract, futures contract, 64,617 contracts to settle at an average of 23.96, down 27 cents. So overall, that's the trade in silver. If we look at the actual storage of silver and we look at COMEX, there's actually been a net increase in silver, I would say, of about 2.5 million ounces over the last 4 weeks, although more of the silver is coming off of London. So there's been a little bit of silver that started to come back to COMEX, a lot more moving off to London. We only have 34 million ounces in liquid silver in COMEX, however, so if there's any sort of run, this could be taken out pretty quick, and then we would see if any of the eligible private contract wants to be put back into the liquid trade and registered. That's up to the individual owners, not to the exchange and not to COMEX. Lastly, we're just going to take a look at this report, and this is the CFTC COT report, or the Commitment of Traders. This data table for several metals, which is produced every week, tells us how each of the individual groups of traders are repositioning. What that tells us is who thinks it's going long, who's going short, and also tells us maybe what the direction of the trade could be moving forward based upon how many contracts are added long and short and who's doing that. Now, this data is as of December 27th. It's usually about a week to 10 days old. So this data is going to tell us where the prices went here. Essentially, this is backward looking. There has been a big change in silver. It has been several months in which the swap dealers, or the bullion banks, what I call the sharps on the market, were net long on silver, pointing to an increase in the silver price, which did happen when we got up to $24. Well, now they're net short by about 7,000 contracts. They added 2,127 short contracts for the week and subtracted off 160 long to go net short for the week's trade of about 2,300 contracts. And so I think now the swap dealers are expecting the price to go down. The managed money is very, very, very long silver. They look to be the dupes in this trade. They'll probably lose money on it. Of course, the producer merchants are net short, as we would expect. They're hedging downward price risk for the silver that they are going to sell in the market. The other reportables are now slightly net long, but moving more to a net short position slightly. And so it looks as though a lot of the smart money on the market's expecting silver to actually fall. I wrote an article for JM Bullion blog last week, I believe, where I looked at the Bloomberg terminal and I looked at what were the price predictions for silver for the next 2 to 3 years. There were several banks and in the swap dealer category which had $17, $18 price targets. There are bullion banks that think the price of silver is going to come down before it comes up. That is entirely possible. I have, in a preview of silver for 2023, mentioned that on JM Bullion as well, the price range could be from 11 to 30 this year, or we could see it go over 30 if we have a big geopolitical event or meltdown in the economy that just forces people into silver as a monetary asset. But regardless of that, if we just have general deflation, inflation cycle this year and what people think is going to go on with the economy, I expect silver price could fall in that initial sell-off and then rise again. And I think the banks are looking at like a $17 target on silver if it does sell off. That also tends to indicate to me that we're going to have a much bigger, broader market sell-off that's going to affect silver and gold paper trade. But I think silver and gold will rebound faster because they typically do. And we'll cover that more in 2023 as we go. Here is gold again as of December 27th. They are very short gold, the swap dealers, 202,000 contracts to 91,000 long. That's more than a 2-to-1 ratio. Of course, short, the producers make sense. They're hedging their price risk until they get the metal to the market. They want to get as much as they can. So they take a short to hedge downward price risk. If the price falls, they make money on the contract to offset the price they lost on the physical commodity. That's called legitimate hedging. This is the only group that does legitimate hedging most of the time. There could be some legitimate hedging in here, but honestly, with all the ounces they have here, I don't think a lot of producers are using it. Managed money is about double long gold. They're 106,983 contracts long, only 56,106 short, and as are the other reportables. The family offices and wealthy individuals are almost 4 to 1, 122,000 long to 3,600 short. Overall, I expect the gold and silver will have a very adventurous year. It looks like people are positioning for different directions in gold and silver for the year. We'll pay attention to that because it matters, because that's what drives price. But the big news here in terms of the bullion trade is the bullion banks have gone net short silver. I expect, therefore, silver to maybe drift off a little bit in price until that's adjusted, unless the rest of the market comes in heavy on the long side and takes the opposite side, those bullion banks, and decides to bid it up. That is entirely possible. We'll see what happens. Unemployment report, not quite what we expect. I think we covered that here. It's not quite as rosy as we expect. So we'll continue to look at fundamentals going through the rest of the year. That's going to do it for this time, ladies and gentlemen. That wraps up the January 6, 2023 weekly market wrap here, put out by Rob Kientz of Gold Silver Pros. Until next time.